All right, this is assignment 21, oral assignment. The contribution margin per unit is most useful to Blue Company when sales increases or decreases. The unit contribution margin is also useful for analyzing the profit potential of proposed decisions. Blue Company could spend money on special advertising or other product promotions to increase sales and still increase income. Blue Company has a contribution margin per unit of $8. The contribution margin ratio for Blue Company is 40%. This ratio indicates the percentage of each sales dollar available to cover fixed costs and to provide income from operations. The contribution margin ratio is most useful when increase or decrease in sales volume is measured in sales dollars. If Blue Company adds money in sales from the sale of additional units, its income from operations will increase. The variable expenses ratio for Blue Company is 60%. A variable expense ratio is a measure of how much a company has to pay in variable expenses to produce a certain number of units, as compared to the amount of money the company receives for selling those units. It also It's also known as a variable cost ratio. A good variable cost ratio all variable expenses while leaving enough revenue to cover fixed expenses as well as earn a profit. A low variable expense ratio is better for business that have a higher fixed expenses. This variable expense ratio expresses a company's variable expenses as a percentage of its net sales and as a means of understanding how variable costs impact a business's net profits. A good operating expense ratios range between 60 and 80%. The lower the operating expense ratio, the better an investment it is. When sales increase to 1,001 units, the income from operations raises to 2,008 versus the original 2,000. When the sales decrease to 900 units, the income from operation falls to 1,200 versus the original 2,000. The break-even point is the level of operations at which a company's revenues and expenses are equal at break-even. A company reports neither income nor a loss from operations. The break-even point in unit sales is 750 for Blue Company. This is the point at which the company has received all variable and fixed costs. The break-even point in sales dollars for Blue Company is $15,000. The break-even point BEP is considered a measure of the margin of safety. The number of units needed to achieve the target profit is 13,075. The goal of most companies is to make a profit, therefore the number can be used to target sales. The margin of safety for Blue Company is 5,000 units. The margin of safety indicates the possible decrease in sales that may occur before an operating loss results. If the margin of safety is low, even a small decline in sales revenue may result in an operating loss. The margin of safety expressed as a percent of current sales is 25%. Therefore, the current sales may decline $20,000 to 5,000 units, or 25% before an operating loss occurs. The degree of leverage is a 4. The degree of operating leverage, DOL, is a multiple that measures how much the operating income of the company will change in response to a change in sales. The difference between contribution margin and income from operations is fixed cost. Thus, companies with high fixed costs will normally have high operating leverage. Operating leverage can be used to measure the impact of changes in the sales or income from operations. Thank you very much.